The government undertakes various activities for the welfare of people. Activities such as medical facilities, defense, banks, education, public transportation, government industries and many more. There is a cost associated with all these activities, so they are basically government expenditures. Money spent on salaries, pensions, subsidies, interests and routine administration and functioning of government facilities is known as revenue expenditure. Money spent on creating assets such as roads, railway tracks, hospitals, educational institutes and machines for government industries is known as capital expenditure. To finance these expenses, government needs money. This money comes in the government exchequer through various sources, such as revenue receipts, which neither create any liability nor cause any reduction in the assets of the government, and capital receipts, which create liabilities and cause a reduction in the assets of the government. Revenue receipts include tax receipts and non-tax receipts. Capital receipts include disinvestments by selling government companies, loans recovered by government, grants received and borrowing. As per Budget 2019, for every 100 rupees the government spent, 77 rupees will come as revenue receipts and the rest 23 rupees will come as capital receipts. Revenue receipts can be classified into tax receipts and non-tax receipts. Tax receipts include income tax, corporate tax, wealth tax, GST, excise and custom duty, property tax and others. Non-tax receipts include profit from government-owned companies, bond issued. Taxes can be further classified as direct taxes and indirect taxes as shown. Non-debt capital and borrowings are major sources of capital receipts. Non-debt capital include disinvestment of government companies, recovery of loans, listing of government companies. Borrowing include loans taken by the government. Government borrows money to cover the shortfall amount for financing all its expenditure. Government borrows from various sources by selling new security bonds, such as borrowing domestically from the public, borrowing from external financial institutions, borrowing from the Central Bank of the country, Reserve Bank of India. The shortfall of money for which borrowing is done is known as deficit. Expenditure is equal to earnings plus borrowings or deficit. Fiscal deficit is the difference between total government expenditure and total non-debt receipts. For every 100 rupees spent, government will borrow a total amount of 20 rupees. Revenue deficit is government borrowing for administrative activities with no asset creation. For 100 rupees spent, 13.5 rupees will be revenue deficit. Prime deficit is calculated by removing interest paid on past debts from fiscal deficit. It is used to get the performance measure of the present government. For 100 rupees spent, 20 rupees will be fiscal deficit and 1.5 rupees will be prime deficit. This is how the government finances its expenditure.